In corporate governance, an independent director is a member of a board of directors who has no significant link with a firm and is not a member of its executive team or involved in the day-to-day operations of the company. A significant relationship is one that can impede a director's ability to exercise independent opinion. In summary, an independent director is a member of the board of directors who 1. Has no material relationship with the company, 2. Is not a member of the company's executive team, and 3. Is not engaged in the day-to-day operations of the firm. Because they are not tied to the present management, an independent director refers to the board member rather than the organization. Their key responsibilities include setting the pay of senior CEOs, making corporate financial decisions based on sound judgment, playing an important role in resolving disputes between two parties. Role of independent director. Independent directors play roles. Take neutral decision. Use an unbiased judgment. Act as a middle person. Duties of independent director. Independent directors are compensated per sitting. The money is also quite good. So, in reality, shareholders are paying for professional guidance. They must always be up to date. They should continually improve their abilities, knowledge, and so forth. That is, to raise the alarm if he notices anything unethical, dishonest, or a corporate violation. He is constantly working for the stockholders and should remain so. They must meet separately, away from management, to discuss the company's present situation. They should not skip meetings since they help them understand the company from the inside out. As a result, they must attend the meetings. Independent versus non-executive director. A non-executive director is a director who is not employed by the organization. On the other hand, an independent director is not an employee of the organization but is subject to a number of additional criteria. They cannot, for example, own stock in the organization. Non-executive directors, on the other hand, are exempt from this restriction. So, while all independent directors are non-executive, they are not all distinct. Stock exchange requirement. The number of independent directors that must form the board varies depending on the stock market. The New York Stock Exchange, NYSE, for example, demands that independent directors constitute the majority of the board. The NYSE defines an independent director as someone with no materiality relationship with the business, while the NASDAQ defines a non-executive director as someone who has no relationship that would interfere with the exercise of independent judgment in carrying out director obligations. Advantages of appointing independent directors. Independent directors are often chosen for selection to boards of directors and are crucial to good corporate governance. A board that is majority independent would be better suited to oversee the CEO than a board comprised of dependent directors. Appointing more independent directors generally results in greater third-party advice and expertise. Since the directors, by definition, do not have a material relationship with the company, they are not subject to undue influence from the management team. With his knowledge and skill set gained over the years, he helps steer the company, serve as a go-between for shareholders and management, resolving disagreements, keeps top-level executive pay in line with standard practices in the sector. It also serves as an external auditor, attempting to uncover any accounting wrongdoing. Disadvantages of appointing independent directors. One example is the risk of information asymmetry, as independent directors are generally less informed about the company than the management team. Independent directors may also not have the requisite skills and knowledge to be an effective board member. These directors are frequently seen serving on many boards. As a result, they lose efficiency since they do not have time to thoroughly comprehend the company's structure and so cannot make an educated choice. Internal management is better knowledgeable of the company's personnel and linked parties. As a result, if an independent director attempts to give judgment without appropriate awareness of the conditions, management will find it difficult to run the firm. In bad circumstances, these directors frequently resign because they do not want to be entangled in legal actions. Conclusion. These are critical for every company. The board of directors makes the final decision. It takes both internal and external directors to strike the right balance and maximize shareholder value. As a result, they should do proper due diligence prior to the appointment.